What's going on, you guys? My name is Zach Hartley, and in this video we are going to talk about how you can make money when the stock goes down and what it means to short a stock. Here we go. Okay, let's get right into it. Shorting a stock. Why would you want to short a stock? Well, shorting a stock gives you the opportunity to make money when the stock goes down. It can also be used as a hedging strategy. If you own long call options in Apple, for instance, you can short the stock and you will make money in case you are wrong on those call options. The third option is you think the company is just terrible, you think it's going nowhere, and you think it's going to be out of money pretty soon. Shorting the stock is probably a good way to capitalize on that position. So how do you short a stock? Well, shorting a stock is actually the exact same process as buying a stock, except when you process that transaction, you're going to sell to open instead of buy to open. And then to close that transaction or exit your trade, you're going to buy to close instead of sell to close. So a little bit different terminology, but it's the exact same process. You just change what type of order you're placing when you enter that position. Now, the big thing here is what actually happens behind the scenes when you click that button. Well, let's talk about Apple, for instance, and use that as an example. Let's say the shares are trading at $100 right now. So when you click that button, what is actually happening behind the scenes is you are borrowing one share of Apple from your bank or your broker, depending on what type of platform you use. You're borrowing one share from them. The next thing that is happening instantly is you are selling that share at the market price. So you're going into the market, whatever the price is at that moment, you are selling it. And at that point, you now owe your bank one share of Apple and you have $100. So that is how you enter into the position as soon as you hit sell to open, execute the trade. That is what happens behind the scenes. You create a small debt with your bank or your broker. You owe them the share back, but you have $100 because you just sold it at the market price and you are now into that position. Now, what happens if Apple drops to $60 and you want to exit that position? Well, it's really simple. You go into the market then and you buy one share of Apple. So that's where the buy to close comes in that I mentioned just a minute ago. So you buy that share of Apple, and then at that point, you've now spent $60. You have one share of Apple and you owe your bank one share of Apple. So you give that share back to your bank. Now your bank or your broker, whichever one it is that you're dealing with, is completely settled up. They want nothing to do with you. You're totally fine and clear. And all you have left is that cash transaction where in the beginning, you sold it at market price and you received $100 for it. Now, Apple has dropped to $60, so all you are doing is going back into the market, buying it back for $60, giving the share back to your bank, and you are keeping that $40 difference. That is the $40 profit, and that is how you make money when the stock goes down. So you short a stock by borrowing the share from the bank, selling it at the market price. The shares drop, you buy it back at the market price, give your bank or your broker back that share, and you get to keep that difference. That is how you short a stock. Now, let's say that Apple increases to $120. This is a little bit different scenario. So it's the exact same steps, but with different numbers. So step 3 is you buy one share of Apple at the market price, which is now $120. You then own that share, you spent $120 on it, and you have to give that share back to the bank. So they clear their debt, you're totally clear, free and clear of the bank, and you're all set and ready to go. However, the cash transaction is what you're left with, and in this case, you it for $100, just like the first example, but because Apple has now gone up to $120, you have to purchase it back at market price, and you have now spent $120 to buy that share back. You have now lost $20 because you received $100, but you spent $120. And so in that case, the Apple share started at $100, it went up to $120, and you lost $20. In our first scenario, it started at $100, it went down to $60, and you made $40. So it's the exact same way as buying and selling. You have the exact same risk return ratio when you were dealing with these types of numbers. However, there is higher risk when you short a stock. So when I talk about risk, I am referring to how much money can you lose and how likely are you to lose it. So when we buy a stock, it's really simple. If you spend $100 on the Apple stock and Apple goes bankrupt tomorrow, it's worth absolutely zero, and you can lose up to 100% of your investment. So really simple. If you buy something, it becomes worthless, it's now worth zero. That's it. It's really simple. How likely are you to lose it? Well, it kind of depends on the company you invest in. If it's a biotech company or some small little venture, you're probably got a decent chance of losing that investment. If it's a long-term dividend paying company that's been around for 100 years and it's Coca-Cola, they're probably not going to go bankrupt. It's probably a fairly safe investment with regards to it not going to $0. However, when you short a stock, you have an unlimited risk. What I mean by that is, if the stock goes way, way higher, you may have to cover that difference, and it could be greater than the current price of that share, meaning that your loss could be greater than 100%. So I'm putting that out there. You can lose more than your initial investment when you short a stock. Now, how likely are you to lose it? Well, that depends again. If it's a big Coca-Cola and their earnings are steady by 5% every single year, they're probably not going to double or triple in value overnight. However, if it's a biotech pharma company that just released a new drug and got FDA approval, that stock could skyrocket 100, 200, 300% in a single day, and it could really hurt you if you have a short position in it. So you really need to balance that. Now, let's look at an example real quick. So let's say instead of Apple increasing from $120, like our second example, let's say Apple increased to $1,000. Let's say it went just skyrocketing. They launched the next great iPhone, whatever it is, and everybody wants it. Apple increases from $100 to $1,000. What does that look like for your short? Well, you still have to go through the exact same steps. So you buy one share of Apple, but now the market price is $1,000. Then you return that share to your bank and you're left with the cash transaction. So in the beginning you received $100 for that Apple share, and in the end you actually ended up having to pay $1,000 for that Apple share, meaning you lost a total of $900 on that transaction, and that's much more than your initial investment. It's 900% more than your initial investment, and that's just the luck of the draw when you're dealing with shorts, because you have increased risk. So you really need to find ways to manage that. Now, there are some ways to manage that. The number one way is position size. Do not put all your eggs into one basket. Make sure you are diversified. If you are day trading, make sure you have control over your positions sizes, and that should be your number one tool when controlling losses and controlling your risk. Secondly, do not fight the trend. If all of your indexes are going in one direction, do not buy a large cap company and place your trade going in the other direction. It's not going to work out in your favor. You really need to buy into the trends that are happening right now, unless it is your strategy to buy a dip or buy a pullback, but you really need to be very careful with those. Thirdly, stop loss orders. If you are going to short a company, you need to make sure that you have an additional order in place that is going to get you out of that position at a certain level that you determine. You need to make sure that you do not have unlimited risk, and you can do that by putting a stop loss on your trade, or at least an additional order that is going to get you out of that trade or limit your losses depending on how that price moves. And the last thing is walk away. When you make a couple of bad trades, or you start the morning rough, or you're out of a couple positions, you need to walk away from those positions or walk away from your computer, get away, clear your mind, and come back to it fresh. That is the only way to reset. You cannot reset by sitting at your computer for longer. It does not happen that way. So in summary, shorting is how you make money when the stock goes down. You do it by selling to open and buying to close. You borrow one share or X number of shares from your bank or from your broker. You sell it at the market, the stock drops, you buy it back at the market price, return those shares, and you get to keep the difference. Thirdly is they have unlimited risk. If you do not have a stop loss on your order or an additional order to get you out of that trade, you are exposing yourself to unlimited risk, and you need to not do that, to never do that, and be very careful when you're shorting a company. And lastly, position sizing is key. You need to be very careful about how much you're putting into each position, into each type of financial instrument, and you need to make sure that you are diversified, especially if you are not day trading. So that is my advice for you. Thank you so much. If you get any value out of this, please click that subscribe button. I sincerely appreciate it, and we will see you in the next video.